For the daily call, I wanted to teach you something and at the same time give you a few trades to catch up on what's going on right here within the futures market and the extremes that this contango and backwardation is going to, and the mean reversion that's going to happen to it. Okay, so for the beginners, what's backwardation? Backwardation is when futures are trading for more than the spot price of an asset. So an asset could right now be at $1, and the futures are trading for only 50 cents. And so right there you have backwardation. And then contango is when futures trade for more than the spot price. And all contango and backwardation tell you is that they tell you the sentiment in the market, and then of course on top of that the cost to carry. And they're almost always mean reverting. And so almost always the futures and the underlying will align themselves together, and they're going to mean revert or close to mean reverting. Okay, so let's talk about how we can take advantage of contango. I'm then going to give you a trade about it. So the way that we can take advantage of contango is to go long an asset at the spot price and then short the futures contract. And so this gives us a guaranteed return. It creates an arbitrage. And so when the futures comes and it settles, then there you have it. You made your full profit. And this essentially creates an arbitrage right here. Now it does have a bit of risk to it because this contango could go even deeper, but seeing that as a mean reverting, that's unlikely to happen. Okay, so real life contango and how are we going to trade this? So this is one of our daily calls for today. And so current example of contango is inside the natural gas markets. And so to take advantage of this, we would want to go long the spot price and then short futures being settled in February of 2020. And so you can make the difference right there. And then how to take advantage of backwardation. The way you want to take advantage of backwardation is to short the current price of the underlying, and then you want to go long the futures contract. So a current example of backwardation is in the West Texas Intermediate oil markets. So we would want to short the spot price, so short contracts for difference on the current spot price of West Texas Intermediate, and then take long positions in the futures expiring about a year from now, and then you can make the spread that's between the two. And so the only thing that's worse right here that could happen is that there could be further backwardation, and so for that reason you want to stay small, obviously, first off, don't want to use too much leverage, secondly, and the third thing right there is that it's unlikely still to happen because it's usually mean reverts. And actually oil is in a normal state of contango because oil has a cost to carry. But right there is a trade for you, two of them actually, contango in natural gas and backwardation in the oil markets. Until then, we'll see you tomorrow.